Imagine putting $80,000 down on a franchise that qualifies for SBA financing, clears the lender's requirements, and generates solid cash flow from day one. The business works, you run it well. 5 years later, you decide to sell and you discover that the buyers who would have paid full price for this business 5 years ago are harder to find. Lenders are less enthusiastic about financing the category, and the number they are willing to pay is lower than what the math looked like when you bought it. The business never failed, nothing catastrophic happened. The category just became less desirable while you were running it. That is the risk most franchise buyers never think to evaluate before they sign. There are 5 signals that a franchise category is shrinking before the numbers on the listing show it. Most buyers never check any of them. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Most buyers approach a franchise purchase the same way. They look at revenue. They look at cash flow. They check SBA eligibility, and they evaluate the purchase price. Those are the right questions. They are just not the only questions. What buyers and owners rarely stop to ask is whether the category the franchise operates in is becoming more relevant to customers or less relevant. And that distinction matters more than most people realize before they are already in the deal. There is an important difference between a franchise brand that is struggling and a franchise category that is shrinking. A struggling brand can sometimes be fixed. New leadership, better marketing, operational improvements. A shrinking category is a different problem. When the customers who used to need what the category provides have found a better or cheaper way to solve the same problem somewhere else, that shift is not reversed because one franchise location improves its service. The underlying demand is moved. A profitable franchise in a declining category is not automatically a bad investment. Some buyers understand exactly what they are buying, price it accordingly, and exit on their own timeline. The mistake is buying one while assuming the category is healthy when the signals are already pointing the other direction. That is how buyers end up holding an asset that gets harder to run, harder to sell, and harder to finance every year. There are 5 signals worth understanding before any franchise evaluation is complete. Here's what each one looks like. Signal 1 is that the customer is leaving. Every franchise category exists because it solves a problem for a specific group of customers. When a growing number of those customers start solving that problem somewhere else, that is not a brand failure. It is a structural shift in demand. And it can arrive from more than one direction at once. Technology displacement is one of the clearest drivers. Legacy retail tax preparation franchises built their entire model around customers who needed help preparing a return and had no practical alternative. Platforms like TurboTax and H&R Block Online changed that equation by offering low-cost and no-cost filing for straightforward returns. The storefronts did not get worse. The alternative got better, cheaper, and available from a couch at 10 o'clock at night. Demographic shift drives category pressure differently. Fitness franchise models built around a specific generation of gym-goers face a long-term demand problem as that customer base ages out, and younger consumers choose different formats entirely. Home fitness platforms and on-demand workout options accelerated a shift that demographics alone were already creating over time. Behavior change works more quietly. Traditional print, copy, and ship franchises have watched volume migrate steadily as document handling moved digital, and consumers discovered they could drop a package directly with a carrier without an intermediary stop. The customer did not disappear. The reason to visit the storefront did. If the category you are evaluating depends on a customer who is being served more conveniently or more cheaply somewhere else, that trend does not reverse on its own. Before evaluating any franchise in a mature category, ask where the new customers are coming from and where the existing ones are going. Signal 2 is that the math is getting harder. This is a different signal from signal 1, and the distinction matters. Signal 1 is about customers. Signal 2 is about what happens to the owner's financial position when customer counts flatten or slowly decline while operating costs keep climbing. Labor costs rise. Rent rarely falls at renewal. Marketing spend increases when customer acquisition becomes harder. In a healthy and growing category, revenue growth absorbs those cost increases. In a maturing or declining category, the top line grows slowly or not at all while the cost structure keeps moving upward. The result is cash flow compression, and it happens gradually enough that it can be easy to miss year over year until the cumulative effect becomes obvious. For a buyer who financed the acquisition with an SBA loan, this compression carries real weight. The monthly debt payment is fixed from day one. It does not adjust because the category got harder. If cash flow compresses after closing, the margin between what the business earns and what it owes every month gets thinner every year. So what does that look like when it plays out inside a real deal? Signal 3 is that the new units stop coming, and this is where the topic becomes genuinely actionable. When franchisees stop opening new locations in a category, that is the market voting with real capital. Opening a new franchise unit requires an operator to believe that the investment will produce acceptable returns over the next 10 years. When development slows in a specific category, experienced operators and investors are signaling something the current listing does not say out loud. Here is why that matters as a data point. The broader franchise sector is still growing. Franchise industry data puts total U.S. franchise establishments at roughly 845,000, and the overall trajectory is upward. That means franchising as a format is not the problem. When a specific category stalls while the broader market continues to expand, that is not a coincidence. That is the franchisee community making a collective judgment about future returns. When franchisees stop opening new locations, that is the market voting with real money. The place to check this directly is item 20 of the franchise disclosure document. Every FDD contains a 3-year table showing openings, closures, transfers, and terminations. If net unit growth in that system has been flat or negative for 2 or 3 consecutive years, that table is telling you something the sales presentation is not. It is one of the most underused signals in franchise due diligence. Signal 4 is that the buyers start disappearing. Most first-time franchise buyers spend their research time thinking about how to get in. Very few spend any time thinking about how they will eventually get out. In a shrinking category, exit difficulty arrives before the business stops being profitable, and that timing is what catches owners off guard. Resale demand weakens as the category becomes less attractive to the next generation of buyers. Lenders become more cautious about financing acquisitions in a category they view as facing structural headwinds. The multiple that buyers are willing to apply to the earnings starts to compress. And here's the part that creates the most financial damage. When a category loses appeal, both variables move against the seller at the same time. Earnings may be lower than they were at acquisition because the category has been under pressure, and the multiple applied to those lower earnings is also lower because buyers have less confidence in the trajectory. A business that never failed can produce a genuinely disappointing exit simply because the category became less desirable to the people who would have been the natural buyers. In the tax preparation scenario, an owner who financed an $800,000 acquisition and ran a solid operation for 7 years can find themselves at an exit where both the annual cash flow and the price a buyer is willing to pay have moved in the wrong direction. Not because anything went wrong in the operation, because the category did. Signal 5 is understanding why the category looks healthier than it actually is. This is the signal that causes buyers to miss the first 4. Shrinking categories rarely disappear. They consolidate. The strongest operators remain profitable, sometimes more profitable than before, because weaker locations close and the survivors absorb those customers. When you look at industry-level data, the numbers can appear stable or even growing. Total revenue for the category holds. Total establishment counts do not collapse. The U.S. tax preparation services industry carries a market size in the billions and still shows aggregate growth at the headline level. A buyer looking at that number would see a large and apparently healthy industry. What that number does not show is what is happening inside individual franchise systems. Unit counts, resale volume, new development activity, and lender appetite at the transaction level are the signals that matter. The headline is not the signal. The unit level trend over the last 3 years is. The trap is reading survivor strength as evidence of category health. Often it just means the best operators are taking market share from the ones who already exited. The middle of the market is hollowing out while the top looks fine. Here is what to take away from this. A franchise category can shrink even when individual businesses are still making money, and the signals usually show up years before the cash flow does. When customers migrate to cheaper or more convenient alternatives, that shift is structural. It does not reverse because the franchise improves its operations. Slowing new unit growth inside a category is one of the clearest early warnings available, and it is sitting in the FDD for anyone willing to look. In a declining category, a profitable business can still produce a disappointing exit because earnings and the exit multiple compress at the same time. And the reason most buyers miss all of this is that the headline industry data rarely shows the problem until it is already well underway. A shrinking category is not automatically a bad investment. Buying one without understanding the trajectory is the mistake. The goal is not to avoid every category that is past its peak. The goal is to understand where the category is headed before you sign. So the decision is yours and not a surprise. If this is the kind of analysis you want before the next deal, subscribe below. Research the deal before you fund the deal.